While you were watching the Fed's interest rate decision last week, they quietly moved $847 billion through a system most Americans have never heard of. And here's what's crazy. This invisible tool is directly connected to why silver prices are behaving so strangely right now. I'm talking about moves that make interest rate changes look like pocket change, yet nobody's covering this. By the end of this video, you'll understand the hidden levers that actually control our economy, and more importantly, how to position yourself ahead of what's coming. Let's get into it. Look, we've all been trained to watch one thing: interest rates. The Fed raises rates, the economy slows down. The Fed cuts rates, markets go up. Simple, right? Wrong. That's exactly what they want you to think. Because while everyone's eyes are glued to the federal funds rate, there's an entire arsenal of monetary tools operating in the shadows, moving trillions of dollars and shaping the financial landscape in ways that directly impact your purchasing power, your investments, and your financial future. According to the Federal Reserve's own H4.1 statistical release from January 2026, their balance sheet operations alone dwarf the impact of interest rate changes. We're talking about mechanisms that can inject or extract hundreds of billions from the financial system overnight. And here's the kicker. Most financial news outlets either don't understand these tools or deliberately ignore them because they're recomplicated and don't fit into neat headlines. So why does this matter to you specifically right now, in January 2026? Well, take a look at what's happening in the commodities market, particularly silver. According to the Silver Institute's latest report, industrial demand for silver hit a record high in 2025, yet prices have been surprisingly contained between $32 and $34 per ounce. That doesn't make sense until you understand what the Fed and other central banks are doing behind the curtain with their unconventional tools. The truth is, interest rates are just the public face of monetary policy. They're the tool everyone sees, the one that gets headlines. But the real action, the stuff that actually moves markets and controls liquidity, happens through mechanisms that sound boring on purpose. Reverse repurchase agreements, standing repo facilities, interest on reserve balances. These aren't just technical jargon. These are the invisible hand actually steering the ship. Let me break down the tools that are actually running the show right now. First up, the Reverse Repo Facility, or RRP. Think of this as the Fed's vacuum cleaner for excess money. According to the New York Fed's data from January 20th, 2026, there's still over $400 billion parked in this facility daily. Here is how it works in plain English. When there's too much cash sloshing around in the banking system, banks and money market funds can park that cash overnight with the Fed and earn interest. This pulls money out of circulation without the Fed having to raise interest rates. Now here's where it connects to silver and other assets. When the Fed adjusts the rate they pay on reverse repos, they're literally controlling how attractive it is for institutions to hold cash versus buying assets like bonds, stocks, or commodities. In December 2025, they tweaked this rate by just 5 basis points. That's 0.05%, and it shifted $50 billion in overnight positioning. That's the kind of quiet power we're talking about. Second tool, the Standing Repo Facility, or SRF. This is basically the opposite. It's the Fed's emergency loan window that operates 24/7. According to a Federal Reserve Bank of New York report from Q4 2025, this facility has been used more frequently than any period since its creation in 2021. Why? Because it allows the Fed to inject liquidity into specific parts of the market without announcing a full-blown quantitative easing program. Here's the genius part. The Fed can support treasury markets, keep credit flowing, and prevent financial accidents, all while maintaining the public narrative that they're still in tightening mode. It's like having your cake and eating it too. They tell you they're fighting inflation with rate hikes, but simultaneously, they're backstopping the system through these facilities. Third, and this one's crucial, interest on reserve balances, or IORB. Have a look at the Federal Reserve's own monetary policy implementation note from January 2026. The IORB is currently set at 4.4%, and this rate determines how much banks earn just for keeping money parked at the Fed instead of lending it out. This is a direct control valve on credit creation in the economy. When the Fed raises IORB, banks have less incentive to lend because they can earn risk-free returns just sitting on reserves. When they lower it, lending becomes more attractive. According to a BI's working paper from late 2025, titled The New Monetary Policy Toolkit, this mechanism has become more important than the federal funds rate itself in controlling actual credit conditions. Now let's connect this directly to silver, because this is where theory meets your portfolio. According to data from the World Silver Survey 2025, industrial demand for silver, especially from solar panels and electric vehicles, increased by 11% year over year. Meanwhile, according to a metals focus report from December 2025, central banks and sovereign wealth funds increased their precious metals allocations by the largest amount since 2020. Yet silver prices haven't exploded. Why? Here's what's happening. The liquidity tools I just described are keeping a lid on commodity price volatility. Through reverse repos and IORB, the Fed is maintaining what they call ample reserves in the banking system. This creates a ceiling on how much speculative capital flows into commodities, because institutional money can earn decent returns in risk-free government-backed instruments. But, and this is critical, this is an artificial equilibrium. According to a JP Morgan commodity research note from January 15, 2026, the physical silver market is tightening significantly. The London Bullion Market Association reported in their January audit that deliverable silver inventories are at a 5-year low. So you've got this bizarre situation where the physical market is screaming shortage, but the paper market, futures and derivatives, is being influenced by these monetary policy tools that keep speculative flows contained. This can't last forever. Eventually, physical reality wins. When the Fed is forced to adjust these liquidity tools, either because of banking stress or because they need to ease financial conditions, that's when you'll see the dam break in silver and other suppressed assets. But wait, there's more they're not telling you. Let's talk about central bank digital currencies, or CBDCs. According to the Atlantic Council's CBDC tracker, updated January 2026, over 130 countries are now exploring or piloting digital currencies, including the United States with the Digital Dollar Project. Have a look at the Federal Reserve's discussion paper from March 2025 titled Money and Payments: The US Dollar in the Age of Digital Transformation. Here's why this matters. A CBDC gives central banks unprecedented control over monetary policy. They could implement negative interest rates directly on your digital wallet, forcing you to spend rather than save. They could program money to expire, to only be spent in certain sectors, or to be taxed automatically. According to a Bank for International Settlements report from November 2025, this represents a complete paradigm shift in how monetary policy is transmitted to the economy. Then there's forward guidance, but not the kind you think. The modern version involves sophisticated communication strategies and market expectation management. According to an IMF working paper from October 2025, central banks now use algorithmic analysis of their own communications to precisely calibrate market reactions. They're literally A/B testing policy statements to control your behavior. And here's one most people completely miss: foreign exchange swap lines. According to the Federal Reserve's own disclosure from the January 2026 FOMC meeting, the Fed maintains standing dollar swap lines with 5 major central banks and temporary lines with several others. During any period of dollar shortage globally, which according to the Bank for International Settlements, quarterly review from December 2025 is happening right now. These swap lines inject hundreds of billions of dollars into foreign markets. This keeps the entire global financial system from imploding, but it also exports dollar inflation worldwide. It's a hidden tax on anyone holding dollar-denominated assets, and it's completely off most people's radar. The bottom line is this: the financial system is far more complex and far more manipulated than the mainstream narrative suggests. But manipulation isn't magic. It has limits. Those limits are showing up in places like the silver market, in banking stress indicators, and in the growing divergence between official policy rates and actual financial conditions. By understanding the tools we covered today, reverse repos, standing facilities, IORB, swap lines, and the coming CBDC infrastructure, you are now ahead of 99% of investors who still think interest rates are the whole story. The invisible hand of central banks is powerful, but it's not invisible anymore, not to you. If this connected some dots for you, make sure you're subscribed, because we're going deeper into each of these tools in upcoming videos. Drop a comment and let me know which tool you want me to break down next. And if you found value here, share this with someone who is still confused about why the economy feels broken, despite what the headlines say. I'll see you in the next one.